All right, let's talk about what's happening in the silver market right now, because something pretty dramatic is unfolding. And it seems like a lot of the mainstream reports are missing the story. The analyst we're following says this isn't just another price rally. No, he's calling it the beginning of the unobtainium phase for physical silver. And that's creating a massive, and I mean massive, disconnect in the market. So let's dive in and decode what that really means.
So get this, in just 1 month, the price of physical silver has shot up an incredible 41%. You'd think the companies that dig that very silver out of the ground would be celebrating, right? Well, here's the puzzle. Their stocks have only gone up by 16%. That leaves this giant gap, and it begs the question, why isn't the metal's success lifting up the miners along with it?
And that gap is a full 25%. Now, the analyst whose work we're looking at calls this the most coiled spring he's seen in over a decade. He thinks Wall Street looks at this lag and just writes the whole rally off as fake. But in his view, they're missing the real story, a story that isn't about peeper trading, but about what's physically happening to the world's silver supply.
So here's our game plan for breaking this all down. First, we're going to look closer at this wild market disconnect. Then, we'll get into this whole unobtainium idea. After that, we'll unpack the simple math behind what's called the profit multiplier effect. Then, we'll check out the real-world evidence for a physical shortage. And finally, we'll see what's being predicted for the so-called catch-up from mining stocks.
You know, this isn't just some small statistical blip. It is a truly historic gap. To put it in perspective, the entire global silver mining industry, all of it, is valued at less than a single company like Home Depot. So our source says the market is telling us one of two things. Either the price of silver is about to completely collapse, or these mining companies are about to see a violent catch-up.
And this quote right here gets to the absolute heart of the argument. It's simple. Stop looking at the numbers on the screen and start looking at what's happening in the supply vaults. The contention is that a severe, real-world shortage of physical silver is the key to understanding this entire situation. So what on earth does unobtainium actually mean here? Well, it's a way of saying that physical silver is becoming almost impossible to get your hands on, at least in large quantities. This isn't just about prices being high, it's about a fundamental breakdown in the supply chain. It's a shortage that the paper markets just haven't caught up with, yet. Okay, so if there's a real physical shortage, how does that turn into huge profits for the miners? Well, it all comes down to a basic financial idea that our source thinks Wall Street is completely asleep at the wheel on. It's a concept called operating leverage, and it's the simple math that could make their profits absolutely explode. So what exactly is operating leverage? It's actually way simpler than it sounds. Think about it. A mining company has massive fixed costs. You know, their equipment, fuel, paying their workers. That stuff costs about the same whether they sell their silver for $50 an ounce or $90 an ounce. So every single dollar the price rises above their cost of production, well, that's not just revenue. It's almost pure, straight profit.
Our source uses a really great lemonade stand analogy to make this crystal clear. Imagine it costs you 50 cents all in to make 1 cup of lemonade. If you sell it for $1, you make a nice 50 cents profit. But what if the going rate for lemonade suddenly doubles to $2 a cup? Your cost is still 50 cents, but your profit just tripled to $1.50. A 100% price increase led to a 200% profit increase. That is operating leverage in a nutshell.
Now let's apply that same exact logic to the silver miners. The analysts suggest that Wall Street's models are still pricing these companies like silver is only at $55 an ounce. Okay, so at that price, with a production cost of about $20, their profit is $35 per ounce. But today, the price is way closer to $93, so that profit per ounce rockets up to $73. The price of silver went up about 69%, but the actual profit for the miners, it more than doubled. That's a 108.5% jump. The argument is that the market just hasn't woken up to this new math.
Hey, just taking a quick pause here. If you're finding this explainer helpful, we'd really appreciate it if you'd like, share, and subscribe. That way you won't miss out on any of our future updates.
Okay, so that's the theory. That's the math. But is there any actual on-the-ground evidence that this unobtainium phase is for real? Let's take a look at the clues our source is pointing to. He points to 4 really big signs. First is the Shanghai premium. Right now, silver is selling for $9 an ounce more in Shanghai than in the West. That acts like a giant vacuum cleaner, just sucking physical silver out of Western vaults and sending it east.
Second, look at the retail level. One of the world's biggest dealers had to set a $500 minimum order. That's a classic sign of supply stress. Third, this isn't a new problem. For 5 years straight, demand has officially been higher than supply. And finally, you can't just flip a switch and get more silver. It takes a decade, maybe even 15 years to get a new mine up and running. Now, I know what a lot of you are thinking. You remember the big silver crash back in 2011, and you're worried about a repeat. But the source argues this time is the complete opposite. See, back in 2011, the rally was all speculation, and the mining stocks were way overvalued. Today, he says the rally is being driven by a real physical shortage, and the miners are 25% undervalued. The fundamentals are basically flipped upside down. So, what happens next? Well, this brings us to the final and maybe most exciting piece of the puzzle. The source's prediction is that these mining stocks are on the verge of a violent and very fast catch-up trade, as Wall Street is finally forced to wake up and smell the coffee. He lays out a pretty clear sequence of events, like dominoes falling. First, in the next few weeks, these mining companies are going to release their earnings reports showing that massive 100+% profit growth. Second, Wall Street analysts will have no choice but to scramble and upgrade their price targets. Third, that's the dinner bell for the big money, pension funds, institutions. And when all that cash floods into a tiny little sector like this, you get the final step, a violent catch-up that could close that 25% gap, maybe even in a single afternoon. So based on that forecast, the analyst shares his own personal 3-phase game plan. And remember, this is his strategy, not advice. Phase 1, for right now, is to focus on the big major producers who are just raking in cash at these high prices. Phase 2, if the price stays high, would be to look at companies that are developing new mines. And finally, Phase 3, only if that big institutional money shows up, would be to rotate into the smaller exploration companies. And on a final note, the source sees this as more than just a simple trade in commodities. He thinks it's one piece of a much larger story, a sort of global monetary reset, where people and even countries are slowly losing faith in paper currencies and looking to preserve their wealth in real, tangible things, hard assets like gold and silver. So that leaves us with the big question, doesn't it? Is this 25% lag a once-in-a-generation opportunity that's backed by the simple math of a physical shortage? Or is it a giant warning sign of a speculative bubble that's about to pop? The on-the-ground data seems to point one way, but the market hasn't quite agreed just yet.